All right, we're going to look at exercise E-8-6 from chapter 8. We started to go over this in class, and I said that I just needed another minute to look through it. So this is with goods in transit. So in this problem, you have the Quack Company's inventory balance on December 31st, 2013 was $165,000. So their inventory balance was 165. This is in dollars. Now it tells you that this was based on a 2013 physical inventory count at the end of the year at 12/31. So physical inventory count, they actually counted these transactions that were physically there. So in number 1, the goods shipped to Quack FOB destination on December 20th were received on January 4th. The invoice cost was $30,000. So these were goods shipped to Quack. So they were receiving the inventory, and it's FOB destination. So we've got FOB destination. What FOB destination means is that if you are Quack, in this instance, waiting to receive the goods, they're not your goods until they've been received at your dock. So let's say, they're getting shipped from company A, you're company B. All the time that they're in transit going along, they're not yours until they are actually received to your company B, FOB destination. Now, keep that one in mind, because we're going to look at a different instance when it's company B sending to company A. So since the goods have not been received, so this was 12/20 is when the goods were shipped, they weren't actually received until 1/4. So they were in transit all this time. They become Quack, who is company B's, on 1/4. So they should not be included in inventory on, this is 12/31. Okay. Then we look at the next. So this is number 1. We look at number 2. We have goods shipped again to Quack, FOB's shipping point on December 28th, and were received on January 5th. So when it's FOB shipping, when A sent the goods to B, and this is A's little shipping dock, as soon as they ended up on this shipping dock, they belong to B. So FOB shipping point, they became Quack, who is B's, as soon as they were on A's shipping point. So this was December 28th, 12/28. They became the good of Quack, who is company B in this case. So we will need to include their $17,000 of inventory on their books. Now remember, the physical count here, right, when they counted the 165, wouldn't include this because they actually won't receive it until when? January 5th. But for legal purposes and everything, it is included. It's included as their inventory on 12/28. So you can see the big differences here. FOB destination, it's not yours until it's reached the destination. FOB shipping point, it's yours as soon as it's on A's shipping block. It becomes your property, and therefore needs to be included in your inventory. Now when we look at number 3, we have goods shipped from Quack. So if Quack's still B, they're shipping to A, right? And this is FOB destination. So on 12/27, B is shipping the goods, and they were received on 1/3. Now in this case, when should Quack, company B, remove the goods from their inventory? Well, not until they've reached A's destination, which hasn't happened until 1/3. It did leave their shipping point on 12/27, so it wasn't included in their inventory when they did their physical count. But again, for legal purposes, because this one's FOB destination, just squeeze it in there. They keep, Quack, who is B, keeps it in their inventory until it's reached the destination on 1/3. So this one also we're going to include in inventory. Remember, it's based on the cost, not the sale. We treat the sale differently. So this 22,000 is also included in inventory as of 12/31. Now when we look at number 4, again, Quack is shipping their inventory. So they're shipping, B, who's Quack, is shipping to A. And in number 4, it's again FOB destination. But in this case, the goods were shipped at 12/26 and were received by 12/30. So when we're looking again at FOB destination, well, we knew that we couldn't take them out of inventory on 12/26, but they were received by 12/30, and we're focused on understanding what inventory should or should not be included as of 12/31. So these goods were received to A by 12/30, so for these ones, nothing should be included in inventory because for the FOB destination, they were received to their customer by 12/31 or by 12/30. Let's say if instead the state here was 1/1, we would have to include it in inventory. But since they've received it by the 12/31, we do not include it in inventory. Now when we look at number 5, goods shipped from Quack. So again, if Quack is B, shipping to A, we have FOB shipping point. And the shipping point date was 12/28, and the goods were received on 1/4. Now remember, FOB's shipping point, as soon as the goods leave Quack's dock, they become property of A and are no longer B's property. Well, that happened on 12/28. Therefore, for this one too, there should be no inventory because the goods transitioned to A at 12/28 at the shipping point. So when you look at this and add up what the inventory should be, you have the 165, you have the 17, you have the 22, which should give you a total inventory of 204,000. When I was reading this problem quickly in class, I think I was reading it quickly and didn't realize the goods shipped to and the goods shipped from. So be very careful when you're looking at these problems. Who are you in the problem? Are you shipping the goods? Are you receiving the goods? Because that will make a big difference on how you treat inventory. This is an extremely important concept to understand because any company dealing with receiving goods or shipping goods will be dealing with these FOB destination or shipping point terms, and just about every single company in the world is at least receiving goods of some capacity, even if you're a service company, your paper supplies and computers, whatever the case may be. It's very, very important that you understand the shipping terms from your vendors and also understand your own shipping terms, because the accounting consequences we can see do have an impact on not only the balance sheet but also the income statement.